Joining us now is Art Hogan, Chief Market Strategist at Wunderlich Securities. Good to have you, Art. Top of the five on a market day like yesterday. Is the bounce overnight convincing enough for you to tell you anything about where we go from here?
No, I don't think so, Sarah. It's interesting that we are getting a bounce, and I think you guys brought up the important point. Now we've got a special investigator. Let's let them figure this out, and let's see if there's another shoe to drop or if there's another bomb to go off. But I think it's better to put this in the hands of a special investigator who was an FBI director for 12 years than to have this sort of tried out by the New York Times and the Washington Post and you and I. And let's move on to the extent that we can. I think we're going to learn more, and there's probably more bombs to go off here. But I think, to your point, at least for today, we know that, this is in good hands. We get to move forward. We're going to learn more, certainly. But, right now, we just don't know what we don't know. I think currently the market is really trying to price in the fact that the agenda gets pushed out certainly into 2018, because when the oxygen comes out of Congress and they have to focus on things like this versus tax reform and repeal and replace and deregulation, then things that we would like to see in this marketplace done in Washington don't get done. So the quicker we can sort of get to the bottom of this, the quicker we can get to the Republican agenda. That's probably a positive. But right now I think this market certainly is pushing out any possibility of that well into 18.
So do you disagree, therefore, with Mr. Siegel that if things get worse and it does lead to some kind of really major issue for President Trump, that markets would rally off the back of that? You think markets would move south if things got worse for Mr. Trump, at least in the short term?
I don't necessarily disagree with the professor, but I will tell you that the math doesn't work for something to happen as quickly as he's speaking. So his comment was, if Trump were to resign tomorrow, the market would go up 1,000 points. That's predicated on the fact that we can compartmentalize this and put it behind us, and there's no really long-term effects. We've got a President Pence, and we've got a Republican Congress, and the Republican agenda is right back on track. Things don't work that way. It's not going to be that clean. So this, in the interim, we don't know how much damage is done and how many Republicans move away from the administration, and we certainly don't know, as we get closer to the midterms, how many Republicans move away from this administration if it's still in turmoil, and that's what slows down, getting anything done, right? So in the case where we can't get anything done, nothing major is going to happen, then I think both investors and Americans will really start to get disappointed. I think the whole thing, the concept of green shoots and thinking things are going to get better, sort of turn into tumbleweeds when these things get dragged out. So I think Professor Siegel brings up a good point, but nothing happens that quickly in Washington.
So what sort of window are we in? Are you a buyer on some of the weakness? Do you want to wait it out and see what happens with the politics? Or are you swooping in names like financials, which have been beaten up so hard, to build up positions again? Just tell us strategically what you do with a day like yesterday, not knowing whether this volatility is over.
Well, so that's a great question. I will tell you this in reverse order. When you look at the financials, that's the classic Trump sector, right? When you think about it, they benefit from everything that the Trump trade wanted to do. They benefit from interest rates going higher because everything he does is inflationary. So yield spreads broaden out, deregulations right there, repatriation of capital goes right to financials. So if in fact we're pushing this agenda out, financials are probably the last place you want to be right now, especially since they're still up about 10% since the election. They're up 24% at some point in time. I think you settle back in. I think this is something, we're not used to volatility. Sell-offs usually don't happen in a day and then go away. I think at some point, let's call it next week, you may well say, okay, enough carnage has been done. Let's pick through the wreckage. And I think that wreckage is going to look something like cyclical companies with good cash flows that are paying dividends. They're probably going to look like industrials. But I just don't think today's stabilization is the time to be jumping in. But I certainly will tell you that we'll probably create bargains over the next several days as this, moves forward and more bombs go off in terms of the news flows. And I think that, the best place to be are, some of the diversified mid-cycle industrials that are, heavy, steady cash flow and dividend payers.
Art, thanks very much for joining us bright and early this morning from Nashville. Art Hogan of Wunderlich Securities.